Uh, Good afternoon, everybody. In the last week, we have discussed about different types of risk faced by financial service institutions. Today's session, we are going to discuss how to manage uh, that kind of risk. So it's simply called risk management. So this is a simple diagram which explains how do risk is managed by organizations. It's a common diagram. It's a common protocol to manage risk. First step is identification of risk. So as we discussed, there are so many different types of risk, and each and every type of risk has its own uh, different source of that risk. So the first step in the risk management is to identification of risk, whether it's credit risk, whether it's interest rate risk, whether exchange rate risk or market risk. So whatever the form of risk, the first they have to identify that risk. And then we move to second step is assessment of risk. Assess. So there are everywhere, everywhere a risk exists, everywhere risk is out there, right? But the severeness of this of that risk is different severity. Some kind of incident, some kind of risk affect very seriously, and some kind of risk affect the organization in a minimal level, right? So first they have to identify risk, and then they have to evaluate the severeness, the seriousness of each risk, the impact of each risk. If the risk is more impactful, if the risk is adverse more significantly, the organization, they have to make some steps, they have to make some measures to assess the risk, right? They have to mitigate such kind of risk. And once they have assessed the risk, and then they have to form a kind of strategies, action plans, how to manage that kind of risk, what are the mechanisms they're going to implement to mitigate that kind of risk, right? So assessment of risk maybe it's assessed based on the probability, the chance of such event, right? Such event. Here the identification, the probability. So why do they manage risk? So they can minimize if they once they assess, they have to take initiations to minimize the risk, and they have to monitor the risk. So whether the risk is developing against the organization, or whether it's go away from the organization. So they have to uh, monitor and control if the potential risk approaches the organization. They have to make steps to control such kind of risk. And the meanwhile they are try to minimize, monitor, control the risk. They have to maximize the realization of opportunities. So the risk is not always the bad thing, right? Right? Risk is simply means uncertainty. Some uncertainties will impact the organization in a bad manner. Some incidents, some risk may give opportunities to grow. For example, COVID-19 pandemic, for many organizations, for many people, COVID-19 pandemic seems a risk. They have the COVID-19 adversely badly impact the economy of many organizations. Meanwhile, COVID-19 gives opportunities to grow, opportunities to find new business opportunities. For example, the Zoom, right? The Zoom is a technological company. So it utilizes the risk of COVID-19, and it grows. Many telecommunication organizations, it grows. They have used the COVID-19 pandemic, and internet service providers and website developers, platform developers, right? So these kind of organizations are developed. So the thing is same. COVID-19 pandemic is same, but the it gives it gives uncertainty. This uncertainty may affect the organization badly, adversely, and also it may give opportunities to grow. So in such situation, in such circumstances, they have to realize the opportunities to upgrade the companies, organizations. And types of risk at a banking sector, we have already discussed in detailed manner in the previous session. Credit risk, liquidity risk. Credit risk mean when the banks, especially financial organizations, give loan to its customer, the customer fails to repay the interest as well as their principal amount. Liquidity risk, the banks, organizations does not have enough liquid liquid assets, cash, a cash equivalent to meet day-to-day operations. And interest rate risk, so interest rate is fluctuate over time. Sometimes interest rate is go up or go down, increase or decreases. So due to this fluctuation, the value asset will be impact. Foreign exchange risk, it's this kind of risk arises especially during in the international trade. Market risk, due to the fair value of the asset, underlying assets and liabilities, underlying asset value of the underlying assets may change, so this may impact on the companies, organizations. Operational risk, their day-to-day operations. So, right, the operational risk, this kind of risk especially uh, impact a particular organization. So for example, employee strike and factory accidents, low quality materials, operational risk. It causes operational risk. Reputation risk, so it may, some events may uh, causes a bad image for the organizations. And risk of governance, corporate governance issue, the people, the governing body who are involved in corruptions, or they are not involving seriously for the betterment of organizational development. So these are the types of risk may occur in financial service institutions. Let us again briefly discuss about credit risk. So it's a risk of default on debt that may arise from borrower failing to make required payment. The method to measure. So now we discuss how to measure. You know what is credit risk. So how do we measure? What is the ruler? What is the scale to measure this kind of risk? So there are two types of methods to measure the credit risk. Number one, expected loss method and Altman Z-Score. There are two types of methods. So when we talk about credit risk expected loss method, so there's a formula. So expected loss EL, expected loss equal probability of default, the chance to fail to repay the money to the bank or financial service institutions. So the chance, right? So probability of customers default within 12 months. So when they look at the very recent history records of the customers, the bank or the institution can assess the probability, the chance, the likelihood of the probability of default, fail to repay the money. Into exposure at default, exposure at default, right? So what is the damage at the time of default? So expected outstanding at time of default. And into loss given default. So ultimate loss as a percentage of exposure at default, right? This is the formula. You just know. So what is the expected loss method? So this is the expected loss method, and here in details given you. So expected loss equal uh, probability of default into loss given at default and into expected exposure at default. So these are here, it's give more detailed information here. So probability of default risk, so it's a likelihood, it's a chance that a loan will not be repaid. The chance that a loan will not be repaid and will fall into default. The customer become bankruptcy. The credit history of the borrower and the nature of the investment must be taken into consideration when calculating the probability of default. So the bankers, before they grant a loan to a particular customer, they can assess the credit worthiness of the borrower, and they may assess the nature of their business. If the project is high risk here, then the chance for default is high, right? So that is what PD. And loss given at default, the credit loss incurred, if an obligator of the bank is default. So if a particular customer has taken 100 million loan, so meanwhile at 100 million loan, he may lost. So it's mean the loss given default equal 1 million, right? 100 million. So if the outstanding balance is just 5 million, so a loss given default is 5 million. The balance, right? The outstanding amount, the credit loss incurred if the obligator of the bank is default. And exposure at default, right? So it's equal to the outstanding loan plus the percentage of unutilized loan commitment drawn by the borrower. Outstanding amount also, uh, they have the borrower has granted additional committed loan. So this is that loan also belongs to that customer. So exposure at default, the total loss equal OS. It's called outstanding loan, outstanding amount plus loan commitment, unused loan commitments, minus OS, outstanding loan, into UGT, right? So this is the formula to assess the credit risk based on the expected loss method. Now it is important, Altman Z-Score. It's a formula. So there is a normal regression, but it gives some weights, right? So there are 5 variables to assess the risk of a particular particular company. Here X1 is denoted here, this one X1. So working capital over total assets. You have to pick the balance sheet, and you have to find that working capital, and it should be divided by total assets plus 1.4 times into X2. What's X2 here? Retained earning over total assets. Retained earning over total assets, and 3.3 times into X3. X3 is earning before interest, tax, depreciation and amortization. Earning before interest, tax, depreciation and amortization over total assets. You can find EBITDA from the income statement. And market value of equity. Market value of equity, you can get the market price of a particular company in the Colombo Stock Exchange or stock market, and you can multiply by number of shares outstanding. So that is market value of equity here. X4 0.6 into X4 in over total liabilities, and finally 0.99 sometimes is equal to 1, right? 0.99 or 1 into X5, net sales into total assets. Net sales into total assets, right? So this is the formula. You can collect the data and you can feed the data here in this model, and you can find the risk level, right? Risk level, credit risk level of the entity based on the Altman Z-Score. So there's a reference, right? By solving this equation, you will get a figure, you will get a number, will get a value. So based on the value, you get the interpretation may differ. Here, the Z-Score. So when you solve this, you will get Z-Score, Z, the value of Z. The Z, if Z is more than 2.67, non-distress zone, this means no risk, no risk, no credit risk. And if the value is below 1.81, if the Z-score is less than 1.81, the company, the firm is under risk. Firm is under risk. If the value is between in these two values, is a gray zone. It gives warning. It gives a red signal, right? It's a warning in between, right? So this is a template. Then you just put the detail. You can enter the total assets, total liabilities, current assets, current liabilities, EBIT. In the formula we call earning before interest, tax, depreciation and amortization, but not all the times we are unable to find that value. And also, if so, you can put this value EBIT, earning before interest and tax. It's very easy to calculate. And you can put the retained earning, and you can put net sales and market capitalization, right? And with market share capital. So it's automatically calculated. Everything is here, right? And you will calculate Z-score, right? Here the Z-score is 1.1. Then it shows what? Bankrupt zone. Is a what? Bankrupt zone. Here is a reference. Right? I will give you a group assignment. So you have to pick up companies. Each group will choose one sector, and they have to report. In this end of this session, I will explain how to submit, how to perform your assignment, group assignment. All right. So I will give this template to do that. We can find more detail about this Z-score calculation in this website. So in this website, you can find this template, Excel template, and we can do your calculations. Now we move to the second type of risk, that is liquidity risk. So it occurs liquidity risk. It occurs when an individual investor, right, individual investor, a business or financial institutions cannot meet short-term debt obligations. Short-term debt obligations. Here, for example, a bank. So normally in a bank, normally people deposit money and withdraw money, deposit money and withdraw money. The bank utilize these deposits to earn profit by the way of granting loan to its customers. So the banks should balance both. When they keep money, when they keep more money in their hand, they will lose the interest income from the loan to customers, and they can satisfy their depositors. On the other hand, if they utilize more money to provide loans for the purpose of making more profit, and they are unable to satisfy their depositors, when the depositors demand for their money, that time bank will unable to pay for that. So in that situation, if the situation arises when the depositors ask for their money, the bank is unable to settle that money to the depositor, that time the liquidity risk arises for the financial service institutions, because they do not have enough money to run their day-to-day business operations. So it's still with very short term period, short term. Suddenly a depositor comes, visit the bank, and they wanted to withdraw 1 billion rupees. 1 billion rupees in a bank at a branch. So imagine, normally banks do not keep such amount of money in the banks cash box. So what will happen? So that time the bank will run out of cash. So it's a situation for short term debt, short term liquidity issues, liquidity risk. So a bank can experience liquidity problem when case outflows exceed cash inflows. Case outflow exceed cash inflows. Illiquidity can be resolved by creating additional liabilities. So what will happen, right? So if depositors demand their deposits, their money, so what normally the banks do is they will get a loan from another bank, another branches. It's called interbank offer rate. Interbank offer rate. So say for example, uh, the commercial bank, a customer of commercial bank wanted to withdraw money from the commercial bank, but unfortunately commercial bank does not have such amount of money in their hand, in their cash box. So what the commercial banks do is they just request HNB to provide a loan facility for very short period of time. So they will settle within 1 or 2 days. So the HNB may offer the loan at interbank offer rate. Okay. So the bank, so illiquidity can be resolved by creating additional liabilities, that is getting loan or selling the assets. If they have liquid assets, if they have bond or other uh, liquid asset treasury bills, so they can sell in the secondary market and they quickly convert the assets into cash. So banks should maintain the level of liquid assets that will satisfy their liquidity needs, but use their remaining fund to satisfy the objectives. So how to measure this liquidity risk? There are two methods. So first method is liquidity coverage ratio. Liquidity coverage ratio. Second one, net stable, right? Stable, not flat, right? Net funding ratio. Stable funding ratio. Right. Now we'll move to liquidity coverage ratio. So liquidity, you know what do you mean liquidity, right? Cash, highly the cash or cash equivalent. The liquidity coverage ratio LCR refers to the proportion of highly liquid assets, assets held by financial institutions. It may include cash, right? Cash to ensure the ongoing ability to meet short-term obligations. The ratio is essentially a generic stress test that aims to anticipate market-wide shocks and make sure that financial institutions possesses suitable capital preservation to ride out any short-term liquidity disturbance that may plouge the market. So they can assess the stress level, the pressure from the market using this ratio to meet, to successfully face the challenges, liquidity challenges. They have to maintain a ratio, right? That is a liquidity coverage ratio. If they maintain this ratio very efficiently, they can successfully, the banks can successfully face the liquidity risk caused by the market. If they not maintain a proper liquidity ratio, the bank has, or the financial institution has, a higher chances to expose at liquidity risk. So this is the ratio, right? So the LCR, the liquidity coverage ratio, requires a banking organizations stocks of high quality liquid assets, very quickly. The banks or financial institutions can convert into cash. There are some assets, say gold coins or checks, very easily, very quickly can convert into cash. When you think about land or buildings, it is very difficult to convert cash very quickly. So LCR, cash liquidity coverage ratio, requires banking organizations stock of high quality liquid assets, to be at least 100%, of its total net cash outflows over a specific time horizon. Um, for example, for the day, the bank expects that 10 million money will be go out. 10 million rupees will be go out. Cash outflow will be 10 million. So the bank keep at least 10 million high liquid assets, high quality liquid assets. So outflow is 10 million, but they keep only 8 million or 7 million. What will happen? They have to face liquidity risk. The bank is unable to satisfy the depositors. Then the bank's reputation will go down and it will lead to the bankruptcy, insolvency of the bank. To keep satisfied their customers, they have to maintain this ratio at least 100%, equal amount of outflow, right? So if the branch estimates that daily outflow is 10 million, and they have to keep at least 10 million cash in the hand. So that's the ratio explains, right? So it's a time horizon is a 30 days. They can take 30 days average. 30 days average. High quality liquid assets over total net cash flows. It should be equal to more than 100%. So high quality liquid assets include cash, treasuries, and government securities. And a total net cash outflows includes stable or less stable deposits, so some people withdraw from money from the deposits. Undrawn credit and liquidity facilities, so some people come visit to the bank to withdraw their deposits. Some people visit the bank branches to apply for a loan, uh, uh, to withdraw, to take the sanctioned amount of loan, approved amount of loan. And credit card minimum payments, credit card, so people will purchase using the credit card, so that amount also should be settled by their bank. So this is the formula. If they maintain the ratio more than 100%, they may, the risk of liquidity is low. The high quality liquid assets include only those with a high potential to be converted easily and quickly into cash. The three categories of liquid assets with a decreased level of qualities are level 1, level 2A, level 2B. So based on their uh, quality of the asset can be categorized into three. So level 1, always money, right? Cash, it's level 1, right? Here this level 1 include cash and central bank reserves, right? So they keep at 100%, right? So at least 100%, no, they should keep 100%, right? So for example, the case outflow, the total net case outflow is 10 million. So equivalent to that amount, they should keep this value, this amount, right? Cash and cash. If outflow is 10 million, they should keep cash 10 million, right? It should be at least 100%. For that 100%, 100%. It means the cash and central bank reserves should be equal to total net cash outflows, 100%. In addition to that, they can keep 40% for corporate bonds and 50% for mortgage stocks. The corporate bonds comes under level 2A, right? It's take a little time. It's take little time to convert into cash. And level 2B, mortgage and stocks. So it also take more time than level 2A class of assets, right? Basel III liquidity coverage ratio explains, gives more explanations. So the liquidity coverage ratio is a component of a Basel III liquidity standard. It is a measure requiring banks to hold high quality liquid assets at least equal to projected net cash outflows, equal to net cash outflows over a 30-day macro stress scenario. So they can take 30 days average. The objective of the new capital rules, specifically the liquidity coverage ratio, is to improve institutions' ability to withstand period of economic stress and functions as a financial intermediaries during those periods, and better reflect the institution risk profile. So net cash outflow include deposit runoff, deposit withdrawals, funding of undrawn credits and liquid facilities, funding of contingent liabilities. So these are the ways of cash outflow, and these are the high quality liquid assets: cash and cash equivalent, agency securities, and government corporate bonds. Now let's move the second ratio, that is net stable ratio. Stables mean what? The fluctuation, volatility, fluctuation, right? So elast, some fund elast, fluctuate. There may be up and down, some lot of waves, right? That is not stable. If it have a lot of up and downs, it's no stable. So if the up and down is very limited, it's like seems flat, then it's a stable fund. Now we look at the net stable funding ratio. Net stable funding ratio defines net stable funding ratio is defined as the amount of available stable fund available, so in hand available stable funding relative to the amount of required stable funding. So how much available in our hand, how much required. So if available is higher than the required, that's a gap. If available amount of stable funding is higher than required amount, no gap, surplus, right? The amount of available and required stable funding are calibrated, so fine-tuned, calibrated to reflect the presumed degree of stability of liability and liquidity of assets. Stability of liabilities and liquidity of assets. Here, available amount of stable funding divided by required amount of stable funding into 100. Here, available stable funding, so the numerator, this part, available amount of stable funding is defined as proportion of capital and liabilities expected to be realized over the time horizon of 1 year. So they can portion of capital and liability expected to be realized, we can sell it over. So right, it's like what, current assets. So it can be converted into cash in within 1 year. And required stable funding is the function of liquidity characteristics and residual maturities of various assets held and those of its off balance sheet exposure. Now we'll discuss in little detail. Right now, net stable funding requirement ratio, right? Net stable funding ratio. Now we'll discuss about available stable funding. So available stable funding is measured according to the relative stability of institutions' funding, including contractual maturity of its liabilities and differences in the propensity of different types of funding provided to the withdrawer, their findings. So here you can find there's a green signal and the red signal. So green indicates stable. There's no much fluctuations, in the prices. There's less up and downs, and here higher volatile, right? It's what there are a lot of up and downs. Here, when you look at the stable one, what capitals, right? Equity capital, liabilities, and preferred equities. It's more than 1 year. It's stable. Stable deposits. There you may observe there are depositors. Normally they visit to the banks to deposit. Very rarely they withdraw the money. Very rarely withdraw the money. All the times they are contributing for deposits or fixed deposits. So if they deposit the money, they will not come to the bank for about more than 1 year. So it's less stable deposits. Then here less stable deposit, less than 1 year, right? Some people today morning deposit, evening withdraw every time. So, right, they put the money, immediately they withdraw the money. So very short period of time the money will be kept into the bank account. So less stable depositors, less than 1 year. So all self funding and all other liabilities. So when it's come down, so stability is less. It's mean high volatility, right? So when you compare with less stable deposits and stable deposit, compare these two, You can understand very well, right? So using the stable deposits, the bank can make loans, lot of loans, but the bank unable to relies on these people, these deposits. Today morning deposit, evening may withdraw the money. So it's the bank will very careful about this. So capital and long-term bank loans and preferred equities, it's not fluctuate over time, right? So it's have more stability. Sum of the total of weighted liabilities and capitals equal to uh, available stable funding, right? So how much amount of money in uh, their balance sheet. It's a asset, equity and liability side. Look at that side. The funding, the financing, where the money comes from, where the money comes from, available stable funding, right? So this top upper part is a stable funding, right? Stable funding. So it may includes equity capital, long-term liabilities, and preferred equity shares, preferred and equity shares. So it's normally more than 1 year, and stable deposit, fixed deposits. So more stable. So this is the available stable funding. Now we move to the required stable funding. Required, the target. The amount of required stable funding is measured based on their characteristic of institutions' assets and off-balance sheet exposure. Right, deposits may be deposit by the bank customers, maybe in the form of cash or maybe in the form of loan. Bank utilizes the deposited money to provide loan to its customer to make interest income, right? So the stable funding is converted into assets. If bank gives loan, that's the asset of the bank. So it's a measured based on their characteristic of institutions' assets and off-balance sheet exposure. Assets of off-balance sheet exposure are weighted according to the liquidity value so that unencumbered shorter term, so less disturbance, right? Unencumbered short term and highly liquid assets receives lower weights, right? Short term period assets here, uh, short term assets will get what lower weights. It's a weighted average, right? So here when you look at here liquid and liquid, before here you may talk about the stability. Right now here we talk about liquidity. Right? So when you look at the asset side, you can at the top you can find cash, reserves, short-term instruments, and high quality liquidity assets, securities, liquid corporate bonds, equities, and gold. Right? The finance institutions may purchase corporate bonds for the purpose of earning some sort of coupon rate in interest income. Equities, right? Stock investment in other equities, and gold. They may purchase some gold, and illiquid assets, loan and other assets, loan, right? So encumbrance, right? So if it is a very short period, it's a high disturbance, high fluctuation, and it's more than 1 year. So when period goes, the disturbance is less. Sum of weighted assets of OBS exposure equal to required stable funding. So you can get more detail on by visiting this website. I have taken this screenshot from this website. So if you want more information on this NSFR, then you can visit this website and you can get more ideas, insights. Right. So now we sum up those two equations. So we to assess the liquidity risk of financial service institutions, they keep the two different types of ratios. The first one is liquidity coverage ratio. So it's simply the amount of money stock of high quality liquid assets and divided by net cash outflows over 30 days horizons, right? The third 1 month. They're measuring up 1 month. So aims to strengthen short-term liquidity profile. So why do we calculate this ratio? So first is aim to strengthen short-term liquidity profile, define level of liquidity buffer to be held to cover short-term funding gaps under severe liquidity stress, and cash flow perspective and predefined stress scenario and time horizon is 30 days. Now we compare this net stable funding ratio. So in the numerator we will have available amount of stable funding. So it normally comprises equities and long-term liabilities and stable deposits, and required amount of stable funding. So here we have the long-term loans of assets, right? It not include a high-quality liquid assets and cash or cash equivalent, right? We have to take this part stable, right? These are things are stable one. These two, liquid corporate bonds and loans and other assets. So it also they have keep more than 100% available funding, right? Available stable fund and required amount of stable funding. So it aims to strengthen medium to long term liquidity profile and defines minimum acceptable amount of stable funding. It defines a minimum acceptable amount of stable funding in an extended firm specific stress scenario and the balance sheet perspective and predefined stress scenario. So time horizon is for 1 year. Now this next part is interest rate risk. It's a long area, right? Uh, so we will discuss about the assignment, right? So I'm going to give you an assignment